You ever look at the charts and feel like there's some kind of script playing out that you just don't have access to? Well, you're not wrong. And today, we're going to pull back the curtain on exactly that. We're decoding the market maker templates that drive price, week in and week out. All right, welcome to AI Explains ICT. In this video, we're diving deep into the core content, specifically Month 7, Episode 3. I'd really suggest grabbing a pen and paper because you're going to want to take some notes. We're about to lay out the whole framework for understanding how the market's weekly cycle really works. So, here's what's on deck. First, we'll get into what the market maker's playbook even is. Then we'll break down the specific templates for both bullish and bearish weeks. After that, we'll look at some really interesting patterns for consolidation and reversals. And to wrap it all up, we'll give you a practical guide on how you can actually use all this stuff. All right. Let's jump right in. The key to all of this, and I mean all of this, is learning to think like a market maker. See, they're not just sitting back and reacting to price like most people. Nope. They are actively, and I mean actively, engineering it. They have a plan for the week. So what in the world is a market maker template? Well, put simply, it's a pattern, a recurring, predictable pattern of price action that you'll see play out over and over again during the trading week. You can almost think of it as the market's weekly script. Its whole purpose is to build up liquidity and then attack it, all to deliver price to a very specific, predetermined level. Okay, before we get into the nitty-gritty of the templates themselves, we've got to talk about the environment they operate in. This is super important. Every single move happens in the context of what we call premium and discount markets. It's really simple. A premium market is when prices are expensive. That's your sell zone. And a discount market, that's when prices are cheap. That's your buy zone. Get this concept down because it's the foundation for literally everything we're about to cover. All right, with that foundation in place, let's see how this all comes together when the overall market bias is bullish. When we're looking for price to go up, our main goal is to figure out when and where the low of the week is going to form. If we can nail that, we can join the big move up. And here it is, the classic bullish setup. You'll see this all the time. After Monday kind of sets the stage, the market will often trade down on Tuesday. Now, your first instinct might be to think, oh no, it's bearish, but don't get faked out. This dip isn't weakness. It's a totally calculated move to engineer liquidity, to shake people out, right before the real move higher begins. So here's what you're looking for. Think of it like a checklist. First, and this is non-negotiable, your overall bias for the week has to be bullish. Second, you're watching for price to drop down into a discount area on Tuesday. Now, this move has a very specific purpose. It's either running sell stops below a recent low, or it's tapping into a bullish order block, basically an area where big players have their buy orders waiting. Once that low is locked in, the market is going to start aiming for a premium level, and you'll typically see the high of the week form by Thursday. Now there's a common variation you need to be aware of, the Wednesday low of the week. In this version, Monday and Tuesday might just be kind of choppy, drifting around, but then on Wednesday, you get that decisive dip into a discount level. That's the setup for a really powerful rally in the end of the week, often with the peak happening on Friday. Okay, let's flip the script. What happens when the market is bearish? Well, these templates are basically the mirror image of what we just looked at. Instead of hunting for the low of the week to buy, now we're stalking the high of the week to sell.
And here's its bearish counterpart in action. When the market's bearish, the playbook is flipped on its head. The market makers will often engineer a rally early in the week, pushing price up on Tuesday to form the high. Why? Well, this move is a trap. It's designed to suck in eager breakout traders and to run all the buy stops sitting there, right before the real move, the major decline, kicks off.
So the conditions are just the opposite of the bullish template. You have a bearish bias, right? So you're watching for price to trade up into a premium market on Tuesday. This little rally is designed to run buy stops or tap into a bearish order block. That's where the big sell orders are hiding. As soon as that high is in place, the target becomes a discount level, and you'll often see the low of the week hit late on Thursday or sometime on Friday.
And, you guessed it, just like the bullish side, there's a Wednesday variation here too. The market might just chop around for a couple of days and then, boom, you get a final push-up on Wednesday to lock in the high of the week. That move right into a premium zone is what sets the stage for a big sell-off for the rest of the week.
But what about the weeks that aren't so clean? You know, the ones where the market just seems to be consolidating or is setting up for a massive reversal. Well, there are templates for that too. And these are often driven by high-impact news, and they are specifically designed to catch unsuspecting traders on the completely wrong side of the market. First up is the midweek rally. Imagine the market is generally bullish. Then on Wednesday, some big news comes out, and it triggers a quick pullback, a dip right into a discount area. This is often to fill what's called a fair value gap, a little inefficiency in price, or to test an order block. That dip is basically the market loading up. It acts like a springboard for a rally into the weekend.
And the bearish version is, you guessed it, the midweek decline. Same idea, just flipped. A news-driven rally on Wednesday pushes the price up into a premium area, maybe hitting a bearish order block where smart money sellers are waiting. That gives you a perfect setup for a short trade, targeting a discount level by the end of the week.
Okay, now this next one is a really powerful pattern. It's called turtle soup long. Here's how it works. The market consolidates for the first few days of the week, just building up liquidity below the weekly low. Then on Thursday, and this is often tied to a huge news event like the FOMC, price makes a sudden, sharp move down, running all those sell stops. But it's a fake out, it's a false breakout. The market then reverses, and I mean violently reverses, and starts gunning for the buy stops that are resting way up above the weekly high. And of course, it has an evil twin, the turtle soup short. It's the exact opposite scenario. In a bearish market, you'll see a false breakout above the weekly high on a Thursday. It's just a stop hunt, running all the buy stops. And that stop hunt is the catalyst for a massive, sharp reversal that aggressively targets the sell stops sitting below the lows of the week.
Whew, okay, that was a lot of patterns, I know. But theory is one thing, right? The real question is, how do you actually use this stuff in your trading? So let's break it down into a simple, actionable framework you can follow. It really comes down to a 4-step process. Step 1, and this is the most critical part, determine your higher time frame bias. Are you bullish or bearish for the week? Step 2, just observe. Watch how the weekly profile is developing on Monday and Tuesday. What is price telling you? Step 3, play matchmaker. Match the price action you're seeing to one of the templates we just talked about. And finally, step 4, frame your trade. Use that template to anticipate where the high or low of the week is likely to form and set your target accordingly.
And as you start to apply this, it's so important to remember a key piece of advice from ICT. Your goal is not, I repeat, not, to perfectly catch the absolute highest high or lowest low of the week. That's a fool's errand. The real power here comes from identifying which template is in play and just capturing the main part of that weekly move. As ICT says, that in itself can be your one shot, one kill.
So if this video helped connect some dots for you and made these templates a little clearer, do me a favor and hit that like button. And make sure you're subscribed for more content like this. And seriously, if you have any questions at all, drop them in the comments below. A real human will get back to you.
Safe tree.